Hi, good morning, everybody. Well, it's morning where we are. Hopefully, it's still morning where you are as well. If not, good day to you all. And thank you for joining us. We're going to get started here in just a moment. So before we do, we'd like to ask that you shut off your video so that you can focus on the presentation that Jamie and I have for you today. Welcome, everyone, to the Mortgage and Insurance Guide during COVID-19. Thank you so much for attending. Now, before we get started, just a couple of quick housekeeping items. We will be taking questions at the end, so please take a moment. You can write them in the Q&A tab at the bottom, or you can also put them in the chat box at the bottom of your screen. And I want to make sure that everyone can see the presentation. So if you do me a favor now, if you can see the start of the presentation on your screen, just type a yes in on the text box there, please. Give that a moment. Okay. Great, thank you. You can see it, good. So now let's begin. Our first presenter is Jamie Pritchard, who has over 10 years of experience in the residential and commercial lending arena. He does mortgages for first-time homebuyers, seniors, and investors, but he has a particular affinity for ensuring self-employed individuals and get the mortgage that they want and deserve. Today, he's presenting his Mortgage Survival Guide to helping you manage your mortgage cash flow during COVID-19. Take it away, Jamie.
Thanks a lot, Rob. I really appreciate it. And welcome everybody out there. My name is Jamie Pritchard, and I am your presenter. One of the things I would like to share with you is over the past few weeks, I have been getting a lot of questions about managing your mortgage deferral. What became very clear to me is that there was some challenges with the mortgage deferral process. And not only that, people needed to be aware of what other options were available to them. My goal here in the presentation is to ensure that you have all of the facts that you need to make a well-informed decision. Now, before I get into the meat of the presentation, I just want to share a little bit about me. As Rob said, I have 10 years of commercial and residential lending experience. I've funded over 1,000 deals, and I do have an entrepreneur focus. The majority of my time in banking was on the commercial side, and I specialize and I'm very versed in mortgages for the self-employed and commissioned salespeople. So let's talk about the 6 options. As I go through these 6 options, I want to let you know that I've structured it in a way that I answer 3 key questions. One is why? Why would you want to do this option? Secondly, what is the cost? Because let's face it, there are some costs associated. Not all of them are free. And where there is a cost, I will share with you some of the cost analysis on that as well. And finally, how? If you want to implement this program, how can you go about doing that? And the first option is to re-amortize your mortgage. Now, this is really quite simple. If you, let's say, are in 10 years of a 25-year amortization on your mortgage, and you have 15 years left, there could be options where you can contact your lender and you can actually extend the amortization to lower your monthly payment. Typically, there is no cost to do this. Each bank or lender is treating this strategy differently and is an alternative to deferring payments. It is a win-win for you. And how do you go about doing that? You call your bank or lender and ask them to re-amortize your mortgage. Just a little tip, if you are using prepayment privileges, now is the time you can take advantage by re-amortizing. You can also go back to your original amortization and reduce your monthly payments. Number 2, stop accelerated payments. Why would you do this? Many clients, when they set up their mortgages, may be on an accelerated biweekly, or in some cases, a lot of lenders will allow you through the course of your mortgage to increase your monthly payments by 20 to 100%, depending on the lender. If you have chosen to do that, you can call your lender to reduce the monthly payments to whatever the minimum is required based on your current amortization. This is very easy to do. There is absolutely no cost. I'm going to share with you an example shortly. And you would just contact your lender or bank or agent and ask them to change your payment frequency to a non-accelerated payment. Now, the example I'm giving you here, I know this is a little bit of a blur, so I will spend a couple of minutes on this. Basically, we have an individual who had an accelerated biweekly payment of $631. This is based on a mortgage balance of $300,000 with a 3% interest rate. If they move to a non-accelerated payment and just pay the minimum that is required to meet the contractual obligation of their mortgage, the non-accelerated biweekly payment is $582, which works out to a savings of $106 a month. Now that might not seem like a lot, but as I mentioned, it is simple, easy, and cost you nothing to do, and $106 a month can go a long way to buying some groceries or extra things that have increased during this time. The third is a little bit more complicated, and that is refinancing your existing mortgage. Why would you want to refinance your existing mortgage? Well, one of the key reasons is you want to be able to consolidate any high interest debt that you already have. So things like credit cards, your lines of credit, car payments, loan, or any loans that you have, you can consolidate everything into one monthly payment. And I'm going to show you an example of where we actually saved a client $826 a month. The cost, it will depend on where you are in your mortgage and the type of mortgage that you have. If you are on a fixed rate mortgage, say over a 5-year term, there would be what's called an interest rate differential, and that is calculated differently by each lender. That could be in the range of tens of thousands of dollars, depending on depending on the amount and the time left on that. The other option is if you are on a variable rate, whether you're on a closed variable or an open variable, the penalty would be 3 months interest, and that could be several hundred to several thousand. But typically, the most I've seen is maybe $2,000 or $3,000 on a $400,000 mortgage, for example. The other key benefit with refinancing your mortgage is equity. You may be able to draw some equity depending on the income that you still have, as income will be required in this. But if you are still employed and have income, you may be able to draw the equity out of your home to provide you with a little nest egg during these uncertain times. Another key thing to know related to the cost is lenders may pay your legal fees, appraisal costs, and in most cases will allow you to amortize up to $3,000 or put the $3,000 in penalties into your mortgage. So there's little or no out-of-pocket expense to you. If you are considering this option, I would suggest you reach out to me. My email is there. My phone number is in the corner. You can text or email me directly to do that. Now here's an example. I am going to just spend a little bit of time here on the left-hand side here. So with the under here, this is the individual's current mortgage balance of $357,000. Their current mortgage payment is $1,995.49, and they have $39,000 in debt, car loan, a American Express card, and a couple of unsecured lines of credit. Those monthly payments, the minimum commitment on those is $880 for a total of $2,875.49. So what we've done is we've We have taken the property value up to 80% of the value of the property, which is $403,000. The closing cost breakdown for this, and as I indicated, some of these costs, the legal fees, appraisal fees, could be paid for by a lender. Bottom line is if you take a look here, the total monthly payment, combined monthly payment is $20.49, which is only $50 more than what their original mortgage payment was. Thus, they're saving a total, and I know that's in the green, that's $826.33. So, the fourth option, to add a home equity line of credit. Why would you want to do this? First of all, it is the lowest cost of borrowing available on the market today. You only pay if you use it, and it's interest-only payments. So this could be used as an emergency fund, and if push comes to shove, you could use this to make your mortgage payments. I would not suggest doing this, but it is an option that is available to you. Cost. The cost will vary from lender to lender. The range would be anywhere between $300 to $900, and it would just depend on if a collateral charge had to be put on. If you want to talk about this, reach out to me and I will walk you through the next steps directly. Number 5, renew your mortgage early. Many of you may be within the last 12 months of your current mortgage, and you may have an offer from your current institution that is indicating if you renew early, they would give you a better rate, but typically it's for a longer term, typically a five-year term. This is probably an easy way to possibly reduce your monthly payments. This will cost you nothing. What I suggest, though, is if you do have an offer, is that you have an independent third party that is not employed by your lender review this for you. I do this all the time for clients. In some cases, it makes sense for them to stay with their existing lender. In other cases, it might make sense because of where rates are to move over to another lender, and I can provide you that advice. So the key thing here is make sure that you get the information and facts from somebody that does not have a stake in you staying with that existing lender. And the sixth is what a lot of you are here for, is the deferral program. If you recall, in the middle of March, Prime Minister Trudeau made an announcement on a Monday that the banks would be offering a 6-month deferral program for that people would qualify. There was very little detail on that, and in fact, what ended up happening is the banks and lenders got inundated with information and details, and it took them a couple of weeks to get things before they got things straightened out. Now most lenders do have a website, a COVID-19 site, which walks you through all of the details. Most of the sites, if you just go to your lender COVID-19, it'll take you directly to that location. But let's talk about the deferral program. Should you decide to defer your monthly payment, here's a couple of things that you need to know. This is discretionary. It's not required by each lender, although most lenders do have some kind of special COVID-19, which will allow you to defer payments up to 6 months. Property taxes typically cannot be deferred if they're being paid by the lender. The other key thing, and this was a big concern because there was a lot of talk going out there that this would affect your credit score. This is just like any other of the forms of payments that we talked about, and through the government regulation, this cannot be reported or hurt your credit score. It's an internal thing between you and the bank or your lender. Lenders will reevaluate on a month-to-month basis this policy. And be prepared to submit some sort of proof of distress. My experience has been with most of the lenders that an actual proof is not necessarily something that you have to provide them, but you just have to answer a couple of key questions. And depending on the answers to those questions, you will qualify. One key, very important thing that you need to know is do not just miss a payment. Don't feel that because you've got a deferral program that you can just skip a payment automatically without talking to your lender first. That will definitely affect your credit score. So please talk to your lender first before you defer anything. Make sure you get something from them in writing that says you are okay to defer. Nothing is free. You need to understand that you will end up paying the deferred interest back and then some. And we don't know how this would impact once you renew. So let's say you're in a 5-year fixed rate and you're now year 3 and you defer for the next 6 months. Are you going to be required to pay that at the tail end, or would it just be added into the amount you owe? I don't know that yet, and I don't think anybody does at this point. We won't have a better idea until after this is done. So that is what I have for you. I'd like to thank you for the opportunity. And now I'm going to introduce Rob Dice and his presentation on the insurance side. Rob has has a lengthy sales background and experience within the insurance industry. And one of the key things that I have found with Rob and why I like working with him is he is really focused on his clients and what is best for his clients. He likes to make sure that he can make things simple and easy to understand, and he's very thorough in what he does. So to give you the insurance in the COVID-19 presentation, here's Rob Dice. Back to you, Rob.
Thank you very much, Jamie. If you'll just allow me to share my screen there, I will get that up in front of everyone. Jamie, if you can allow me to share my screen, that'd be great.
Okay, let me, sorry.
There we go.
Okay.
And we'll get my presentation up here. At least you folks know that this is absolutely live. We're not making this up as we go. Anyway, thanks, Jamie, for the introduction. As Jamie mentioned, my name is Robert Dice, and I call my business and I call my process Insurance Made Simple, helping simplify getting the right insurance you need to protect you and your family. So why do we have life insurance? Well, there's many different reasons. It could be to cover final expenses when someone passes. It could be to replace lost income so that the family has that income replacement should the breadwinner not be around any longer. It could be to protect a debt. For example, you may want some coverage to make sure that your mortgage is covered. It could be to leave a legacy. Perhaps you want to leave something for your children or your grandchildren. Many wealth advisors consider life insurance as part of a wealth planning strategy. And the reason that they do that is it helps to diversify someone's portfolio, because life insurance is very stable, and so that helps to spread out the risk in someone's portfolio. And it can also be used in tax planning, both in a personal and in a corporate strategy. So what is life insurance? I had a gentleman share this with me one time, and I like to bring this up for folks because I think it kind of goes to the core of what life insurance is. Life insurance is really money. It's money that you are buying today at a discount. And that sounds a lot like an investment. Insurance is money that's going to be seen at some time in the future. Could be your family, could be your grandchildren, but you're able to buy that today at a discounted price. So who am I and what does insurance made simple really mean? Well, I'm a life licensed insurance professional here in the province of Ontario. And I started my insurance career as a group benefits specialist. And the very first group that I worked with, when I finished working on the plan for them, the administrator on that plan came to me and said, I'm a single mom. I have a 2-year-old. What can you do to help me save for my child's future? I want to do whatever I can to help him. And right at that very moment, I went from being a group benefits specialist to being on the personal side immediately, because that is where people wanted me to be. When I first started studying all the life insurance, in working towards getting my license, I realized that I had made a lot of mistakes in my young adult life in terms of life insurance and investments. And the reason was I simply didn't have an advisor who took the time to walk me through it so that I understood it. I mean, I got a policy, I did some investments, but I really truly didn't understand it. And so right at that point, I decided that my specialty was going to be in making sure that my clients understood what we were doing, why we were doing it, and how it was going to benefit them. And I'm an independent advisor. What that means is that there's no sign up here over my head. I don't work for any one particular insurance company. And what that allows me to do is find the insurance plan that's right for you. We've got a lot of great insurance carriers here in Canada, but not all plans are exactly the same from carrier to carrier, and they do vary in cost, of course. And so it's my job to make sure that I find you the right plan as opposed to filling someone else's pipeline for how many sales they're supposed to get. So, life insurance during uncertain times. And if you've ever wondered, insurance advisors talk all the times about what ifs, the what ifs in life. What if something happens? Well, I would say that this pandemic would qualify as a what if, because I don't think anybody really saw this coming. It's very difficult to prepare for. There was a quote in the Globe and Mail the other day from Dr. Moira Somers, and she's a psychologist who works in the financial industry. And I thought her quote was very telling. One way of settling death anxiety is by knowing that you've done everything you can to tend to people you care about. Obtaining life insurance can help individuals exert that control. So a life insurance contract is guaranteed. It is something, our insurance industry here in Canada is very stable. It's part of a $4 trillion industry. And the government of Canada makes sure that our carriers are very secure and that the promises they make to pay out contracts are there. And so when you have a contract, which is a policy with an insurance company, it is very secure. When the stock markets go up or down, those guarantees are still there. And even though we're living through uncertain times right now, the need to protect your family, to protect your debts, protect your assets is still there. Perhaps you've set aside some money so that the kids can go to post-secondary education. If something should happen in terms of your income or something should happen to you, you want to make sure that your kids are able to go to school. And insurance policy can certainly help with that. Now, some of you may have group health benefits through your workplace, and part of that might be a life insurance policy. Now, it's usually a smaller fixed amount, but the thing about a group health policy and a group life insurance plan in particular is that you're not in control of that plan. That control goes with your employer. So should you leave that employment, should your company happen to close, should you move on, that policy is not going to go with you. So you need to have something personal that you are in control of, and having your own life insurance plan in place is the best way to do that. So how has acquiring life insurance changed? Well, as you can see, I'm sitting there, I'm working from home. Like everybody else, I'm working from home, but there's a couple of things that have not changed. And one is that I still do a needs analysis with you. We have a conversation. It could be by phone, email, or video. And you tell me what's going on in your life. Tell me what we're trying to protect, how we're going to do that, what kind of commitments you've made in terms of debt, in terms of your family. And then we start working on a plan that fits your needs. Now, one of the things that the insurance carriers have gotten on board with is digital applications and digital signatures. So what that means is we could be doing something very similar to this, having a conversation, live video conversation. I could be sharing my screen with you as we go through your application. And then when it's time to sign that application, you could do that on your computer, or you could sign it right on your smartphone. Medical underwriting, that's the process of asking questions about your health and perhaps further examination of your health. Those thresholds have been lifted in most cases across all the insurance companies. And what that means is that it used to be that $500,000 of coverage was kind of the magic number, and anything below $500,000 was just some basic questionings, and then anything over $500,000 usually would involve a third party asking you some questions. Perhaps there would be fluids, meaning blood and urine samples and so on, and a more in-depth examination of your health. Well, those limits have been raised now. For the most part, they're up to $1 million. And so what that means is that it's much easier to qualify for medical underwriting. So if you perhaps have been an individual that has been denied before because of a health concern, this would be a good time to look at that again, because those restrictions have been lifted. Now, should you need a larger amount of money that in your policy that still would require medical underwriting, what we can do is we can put a smaller amount together now, and then we can increase that later once the medical underwriting starts being done again. The companies that go out and do that, they send out the health nurses and so on to ask the questions and take the fluids from you, of course, are not in the field right now. They're not out having those visits. The insurance industry themselves, much similar to what mortgages are doing, have offered some premium deferral options. And so what is currently happening is you can defer your premiums for 3 months. And then at the end of that 3 months, you have to start making your payments again. And those 3 months that you missed, you can defer those over the next year. So you can kind of chip away a little bit at those 3 months that you missed. Most of the carriers are doing that. For the carrier that you're with, we would need to ask some specific questions of them just to be sure. The other thing that's happened, and well, there's only one insurance company that's doing that right now, and this is Canada Life. And what they are doing is they are offering you the option to have less coverage. So let's say, for example, you've got $500,000 of life coverage and it's expensive for you right now. What you could do is lower that to amount maybe $200,000 or $250,000. You're going to pay less money for that amount of insurance. You're not going to be able to defer it. You're just going to have less coverage. And then once your financial situation straightens up a bit and you can afford your full premiums again, you can increase back to your previous level. There won't be any medical questions that will be done. You just need to be comfortable. If you're going to do this, you need to be comfortable that you're okay with a lesser amount of coverage right now while you're going through these financial situations. On the group health benefits side, what they have done is they're deferring payments for three months as well. But then after that 3 months, the carriers are going to be looking for a balloon payment, which means you're going to have to catch up on the insurance, on the payments that you missed. Unless you happen to be working with a third-party administrator, at which point they are helping to kind of fund that over the next year for you so you can get caught up. So if you have group health is a little bit different than straight life insurance, but there is some relief there should you need it. Why is this a good time? Well, as I discussed, medical underwriting has never been easier. And the other thing, that there's some rumbling in the industry that when we emerge from this pandemic, cost could be going up. It could cost more for the same amount of life insurance that you have now, or that amount that you're paying now could buy less. Now, if you have a plan already in place, none of these changes will affect you. What this will affect is new plans that are put into place after the pandemic is over. So while it's not written in stone, you can probably expect that some costs are going to go up. So bottom line is, it's a great time right now to make an investment in your life insurance. So next steps. Well, if you currently have insurance coverage, a review of what you have. Make sure that you have the right kind of insurance, you have the correct amount of coverage, make sure that you're paying the correct premium, and if there's been a change in your health, that health change has been reflected on your policy. Now, what I mean by that is, I'll tell you a quick story. A gentleman bought an insurance policy a few years ago. At that time, he was on some medication, and so because of the medication, his premium was just a little bit higher than normal. After a period of time, came off that medication, but never told the insurance company. His advisor did not ask the question, and so he has been paying an elevated amount of life insurance for an extended period of time that he didn't need to be paying. So my point is, let's make sure that you're paying what you're supposed to be paying. And if you are looking at getting a new policy, of course, we would be doing a needs analysis with you, making sure that we're getting the right coverage. Has your partner or your spouse been properly insured? Think about it from this perspective. Should something happen to your partner or your spouse who's staying at home, perhaps looking after the family, how well would you cope with that? And how well would you be able to replace all of the things that your partner is doing for your family? Do you have plans in place for your children? Education plans as well. Now, on a legal side, do you have your will up to date? I know many people find putting their will together a thing that's a little discomforting to do, but this is a great time because you're spending time with family. You're maybe having discussions that you've never had before about life and where things are going. So this would be a great time to do your will, discuss your wishes, make sure that you've got your POA. That stands for power of attorney. And there's two kinds of power of attorney. There's one for legal and there's one for health. And should something happen to you, this would be the person who would be able to make those decisions while you're not able to make them for yourself. And as always, any of the analysis that I do for you, any of the recommendations that I make are completely free of charge to you. So thank you for the time. I appreciate you listening to me. I think that we are going to take some questions now. I see Jamie's come back on there, and we will answer some questions for you now.
Thanks, Rob. That was great. So are there any questions for me at all?
I see a question over here in the chat box with relation to mortgage. I currently have a mortgage. I'm 5 years in. When would it not be a good opportunity for me to do a deferral? What sort of circumstances would not reflect well on a deferral?
I don't think there's any, I think the key thing there is if you can make the payment, if you can make the monthly payment, it would be best to do that. As I indicated, I don't know what the impact, none of us know what the impact is going to be at the tail end. I suspect what will happen is the interest and payments will simply be added at the end of the mortgage, which simply means that you will owe more at the end of the mortgage. So, if you're okay with that, then you can do that. The other thing to keep in mind too, though, is if once we get past the tail end of it, you want to accelerate payments, as I mentioned, is most institutions will provide a 20 to 100% increase. You can increase that monthly payment to limit that the impact down the road. It doesn't have to be a lot. It could be an extra $50 on a biweekly payment. That can go a long way to affecting that.
Very good. All right, thank you for that. I see another question here. Actually, it's for me. I have had health issues in the past and I have been declined for coverage. Would this be a good time for me to look at it? Absolutely. If you have had health issues in the past, perhaps you've been declined, there's two or three things going on. First of all, as I mentioned, medical underwriting has gotten a little bit easier right now. The second thing is that many of the carriers are offering what's called a simplified issue. And what that means is that there's not nearly as many health questions. The people that are applying for that kind of insurance have perhaps had some health issues in the past, so they recognize that. So there are ways of finding you a plan, even if you have had a health issue in the past and perhaps you've been declined. This would be a good time to have a look at it. And the other thing that I can do, many of the insurance carriers are allowing us to do a preliminary investigation. And what that means is that I'm not sharing your name with them. I'm not sharing any of your details with them other than your age, your sex, and some health information. So I can get a read from the insurance company on what we think we could do for you without identifying you. So that way, if they say, no, it's not going to work, nobody knows that we looked at it for you. And and one of the things that insurance companies do is they compare notes to one another. So if you happen to apply for a policy today and you are declined, we have to report that the next time we apply. So by doing this preliminary, we get around that. So it really does help to simplify, and it protects you because it gives you an idea of what's out there, what it might cost, and whether you're going to be approved. Before we go through this whole thing, you get your hopes up that you're going to get this coverage, and then I can't do it for you. So this is a good way of going about it. So even if you do have a previous health concern, this would be a great time to have an investigation as to whether we can get the coverage that you really need.
Rob, I see another question related to that. And I think what the question is if I have a condition and I get my insurance, is there going to be underwriting later? Like, could it be turned back? And oh, sorry, we didn't mean that. It was unprecedented circumstances. So
No.
what would happen? No. Okay.
No. Once a plan is approved, if like as I mentioned, medical underwriting has been relaxed some right at the moment. So any decisions that are currently made will be upheld. The other thing about medical underwriting is if we approve a plan for you today and everything is approved, the plan is in place, everything's good, and a day later you happen to become ill with something, doesn't matter. On the day you were approved, everything was as it should be. So in terms of them going back in the future and saying, listen, we want to revisit this, it's not going to happen. They're going to make a decision based on today. They're going to move forward with it, and they will honor that. And this is one reason why, if you've got life insurance right now and you're thinking, boy, you know, it's really hard for me to afford this, I think I'm going to cancel my policy for now and I'm going to reinstate it later, or I'm just going to get a new policy later. You want to be very careful with that because you are already approved right now. You don't need to do anything. You're covered. Should you cancel your plan and decide to do something with a new plan later, you could be declined because of a medical problem. So it's better, as they say, to leave sleeping dogs lie, continue on with where you are rather than give up something that is already guaranteed.
Perfect. Good. One other question that I see here as well. How much insurance is enough? And there's sort of a second part to that. Like, what do you base the amount of insurance on? Well,
this is part of the conversation that we have. And when I say that I want to know what your story is, that's part of it, because not everybody requires the same amount of coverage. The insurance carriers all have these fancy formulas that they go through. I met a person recently, a business owner, who I didn't feel right getting a policy for. We had a conversation, and I did not do life insurance with them because they didn't really need it. They had investments, everything. They didn't owe any money. Their children were long out of the house and on with their own. They didn't feel like they wanted to leave a legacy for grandchildren. And they were someone who actually, and I probably should never say this, but this person did not need life insurance. Now, that is a very unique case. Most people, what we talk about is, what debts do you have right now? What money do you owe? Do you owe, as Jamie's example earlier, there was a mortgage there was a car loan, there was lines of credit. Should something happen to you, those would need to be paid off. So those are the first things we look at. Then we look at, how much are you earning right now? So take your salary out of your family dynamic. How is your family going to carry on without your salary? And a good rule of thumb there is 5 years. 5 years of net. So that's after taxes. That's just, because don't forget, an insurance payment is a tax-free, or an insurance payment is a tax-free cash that you would receive. So pay off your debts, make sure that your family's got some money there. So I guess the answer, Jamie, is there's not really a defined number that works in all cases. It also depends on what stage of life you're at. If the kids are out of the house and gone, right, you're not thinking about paying for their education. If you're just getting started in your adult life, perhaps you have a partner, you have a house, you have small children, then you have more things to consider. So it's on a case-by-case basis. There is no one answer fits all. And this is why I need to hear your story so that I understand what's right for you.
That's where the needs analysis comes in.
Well, and the other thing that fits into that needs analysis is there are different kinds of insurance. Some of it is just strictly to cover a debt. Some of it is more long-term, a plan that you would have for your entire life. And so it really depends on what kind of insurance is going, and it can get complicated. Life insurance can get complicated. It's the same with mortgages. Mortgages can get really complicated when you get into the fine print. And that's why you need someone who can help walk you through those steps to make sure that you understand what it is you're getting.
Good. Are there any other questions?
One more question on mortgages I see here. You mentioned different kinds of lenders. I have heard somebody talk before about A lenders and B lenders. What does that mean, and how does that affect what's going on right now?
So a lot of what I referred to as far as the deferred payments would fit into what are A lenders. So A lenders are the big six: BMO, CIBC, Scotiabank, TD, RBC, and National Bank. They are federally regulated. All lenders are federally regulated, but they basically go into the relief that the government has given by buying back mortgage bonds are with those lenders specifically. To a lesser degree, we used to call them alternative lenders. That has changed somewhat because it now breaks down breaks down into B lenders. And what the B lenders are is they're not necessarily a bank, they're just strictly lenders. So they just lend money for mortgages. They don't have bank accounts, deposits, those types of things. So typically when you hear about an A lender, they're a bank. They have more than just mortgages that they're doing. The B lenders are still guided. Certainly, if you're applying for a CMHC mortgage, all of those lenders, whether you're an A or a B lender, would have to meet the government guidelines. So it's, if you're putting in less than 20% down, there's no lender that we can sort of sneak through and say, hey, you can go to this. The other The other thing is as well, with the benefit with the B lenders is they can change some of their policy because they're not just getting their money from the bond market. There are investors and other institutions and private investors that are giving them money, and they set the guidelines. So they can be a little bit more flexible when we're talking about when we have at least 20% equity in the market. That's it.
So I would guess the bottom line is if you have questions about how this might affect your lender and wherever you happen to have your mortgage now, it's just a good idea to ask questions.
Exactly. Exactly. And don't be afraid to ask questions, because a lot of people I find, and probably the same in your industry, they listen to well-meaning family members and relatives that are hoping that they're giving them great advice, but they're based on fear. And there's a lot of fear going out there right now and a lot of myths in both of our industry. And we really hope that this has helped demystify some of that.
Absolutely. We are living through unprecedented times right now. And so, you know, to be informed, to have the correct information in front of you is always the best way to go.
Yeah. So I want to thank everybody for being on this webinar. And from my end, I truly hope that you have learned something. And if nothing else, will help you make an informed decision on how to manage your mortgage cash flow. Rob?
Absolutely. Thank you everyone for your attention. I really appreciate it. If you have questions, don't hesitate, reach out, give me a call, send me an email. Love to have a conversation with you. And if there's anything that I can help clarify for you, I would be more than happy to do so. So take care, everyone, and be safe.